The market is shifting for real estate. You want to know where we're currently at and where we think we're going? Stay tuned. Hey, everybody, Tim Weigel here with Watson Realty, and I got some news for you. We can definitely feel a shift in our real estate market. Today, we're going to kind of look over some of our performance metrics that we normally do. And at the end, I got my Tim's takes. I'm going to tell you exactly what this is going to mean for us. So, and it might surprise you if you ever read some of these headlines out there. So, and just to give you a heads up, the way I would look at some of these real estate headlines that you might be seeing in the news is there's a saying, if it bleeds, it leads. So it's going to sound very negative because it's going to draw you in, but it's not necessarily the fact of what the market is when you look at the statistics. So let's see how we've done the last 7 days through yesterday. So as anticipated, we're seeing an increase in inventory. So this is one of the highest peaks we've had all year. And a lot of that's because more homes are going active, partially because of the fear of where the market could be heading. And because of that fear that they're reading in the headlines, buyers are hesitant of being as aggressive as they were for the last year and a half, 2 years. So, but we're at 6,248, pretty much across the board. All counties have increased, some more than others. We're almost double what we were at the beginning of January. So, and I wouldn't be surprised if next week when we talk about this, we are doubled. Now, solds, because you got more actives, eventually more solds are going to close. This is kind of a lagging indicator, so it's not going to be leading. So when we start seeing that shift in the market with the increase in actives, it's going to take a little bit before it shows on the sold side. But you could start seeing it kind of crimping up a little bit as we are almost over 1,000 sold again. Still a far cry from the 2 weeks where we had over 1,400, but we'll get there. Median sales price. Again, we'll start seeing some of the effects of what it plays on our median sales price week over week. But for last week, it was a slight decrease from the week over. A lot of it's because this has been a very busy week. You got a bunch of negative impacts of the economy being reported. You got the Fed that increased the points by 0.75%, which we'll talk more about that in a little bit. But all that negativity is putting a crimp on some of the market temporarily. Days on market, relatively still unchanged. Some are moving fast, some are moving slow. But again, this is also a lagging indicator of what's to come. When it comes to days on market, we're going to start seeing this one creep back up more in the double digits across the board. We're just not there yet. Now let's talk about some of my thoughts. So the market has officially shifted. Everything we're seeing out there in the market, it has shifted, and we're going to be in our new normal market. Now, it doesn't mean a correction, doesn't mean a softening in the market, doesn't mean any of that. It's just a new normal. We've been in an extraordinary market for the last couple of years. Growth has been outrageous. Home prices year over year has been incredibly insane. But what we're going to start seeing with this is we're going to see more price decreases in the MLS. That does not mean that property values are going down, but we used to be, with the way the market's been, sellers could list a home, throw up the ridiculous offer of what they want, and miraculously get it even though the comps didn't support it. Those same sellers that are doing that are now going to struggle to bring in those offers. So they're going to have to decrease it to what the real value of the home was, the way that we used to price homes prior to the pandemic. We're going to see an uptick in active listings, which we're already seeing. I know for zip code 32817, in late May, they had 7 active listings, which means you can pretty much get some crazy offers. As of today, they have 32. So that's almost a 4-fold increase. So, and we're going to see that in many different areas. And then this is a really good news because during this pandemic and crazy offers, we've had a lot of issues with buyer fatigue. Well, you're not going to have that anymore. Buyers have more opportunity. They're still going to be in a seller's market, because we're still going to be probably 15 to 30 days inventory supply. But buyers won't have to. Home comes live at 8 p.m. I better get in there by 9 p.m. So it's going to put less stress and strain on the buyer, so the buyers can do it. It's also going to open up a lot of avenues for VA buyers. It's going to open up avenues for first-time home buyers. So open up avenues for those that can't just pay cash for everything. So that's a good thing. Now, even though they're saying the market is on shaky ground, we're not. We're still a steady market. People need a place to live. We still have a supply issue. Demand is still there. With rising rent increases, it's going to actually push more buyers to where they look at purchasing. Because guess what? Whatever happens to the market isn't going to do anything to us. Because once rent goes up, can go up every year, does not happen when you're the buyer or when you own a home. When you own a home, your rent's not going to go up every year because of rental increases. So you're fixed for your mortgage. So it's a good thing. Now, I know some people correlate a lot of the basis points, 0.75 points being raised by the Fed into your mortgage rates. That's not the case. Them raising it 0.75 points does not correlate to mortgage rates. Now, because of it, it could impact it indirectly, but the mortgage rate is a free market. It goes up and down based off demand. So it's not going to come up where they raise the 0.75, we go up 0.75 immediately. No, what happens is there's a secondary bank, the Federal Reserve, that all banks get their money that they loan out. So because of the cost that they have to borrow money from them at 0.75 increased higher, it'll eventually get passed on to the consumer. But based off the demand of the market, it doesn't equal dollar for dollar to the consumer necessarily. So keep that in mind. Now, it doesn't mean that the rates won't eventually raise, they will, but it's not direct correlation to the Fed. Now, I do anticipate we're still going to see home prices increasing. So for those of you out there looking for this bucket dropping out to find a deal at a cheaper price, you might be waiting for a while. So, but rates will, or price will still increase, just at a slower rate. You're not going to see 20, 25% year over year. You might see 3%, 4%. So a more normal market. Now, one thing that I saw over the weekend that I thought was very good when people are looking at rates and buying a home, remember, you are married to the home, but you're only dating that interest rate. So if you get into a rate at 6%, even though you might not like it today, you can refinance it at a lower amount later on. So you have options later on in the loan process. So, but you're only dating it today. Hope this helps you guys. As always, you can always connect with me. Here's some of my information. The market's going to be a little bit shaky the rest of the year, but it's not shaky because it's unhealthy or it's a bubble. We are still in a good situation. So let's go out there and get yourself into home ownership. It's the best way to build wealth in 2022. I'll talk to you all later, and you have a great rest of your Monday.